You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble. His website, dollarcollapse.com. Welcome to the show, John.
Hey, Jim.
The world's biggest insurance company is in trouble. What's happening at Lloyd's?
Well, low interest rates are theoretically bad for insurance companies because they take in their premiums and they price their policies based on being able to invest those premiums at a given rate, usually in the bond market. So they want 6, 7, 8% on their bond portfolio. Well, interest rates are plunging. And so now an insurance company owning a lot of high-grade bonds is lucky to get 1% or 2%. And that's not enough money to justify the current pricing structure in the insurance industry. So these guys are taking big write-offs. Lloyd's of London just announced a big loss because they had to take a write-off on their investments. Their investments are no longer worth what they were projecting that they would be worth. And pretty soon, they're going to have to raise their premiums. In other words, they have to increase their prices enough to offset their falling investment income, and that's going to scare away customers. So you got the real danger of an insurance industry death spiral if interest rates stay at current extremely low levels, or especially if they go negative around the world the way they are now in Japan and Europe. So huge problem for a big, big part of the finance industry. Same thing with money market funds. If your yield on a money market fund is negative, then the money market fund has no reason for existing, right? Because cash under the mattress is a better investment than that money market fund. And at the other end of the spectrum, those are fairly conservative investments that don't take big chances and therefore aren't able to generate any kind of a return. The big banks, which have become essentially hedge funds over the last few decades, where they make most of their money by taking big chances on their proprietary trading desks with their own money, they're getting crushed by the fact that a lot of the exotic instruments that they used to make a ton of money trading are now not trading anymore. Junk bonds are just kind of sitting there because nobody really wants to take a big position in junk anymore. So the bonds that are out there just aren't trading, and so the trading desks at the big banks are kind of shriveling up. And Credit Suisse, the big European bank, just announced really bad results. And as you told me before we got on, I hadn't seen this, a lot of layoffs. They're laying off several thousand highly paid traders and investment bankers. And that's because they aren't doing a lot of deals, especially in energy anymore. There's not a lot of mergers and acquisition. And the bonds that have been issued by the junk borrowers of the past few years aren't trading. They're just sitting there because nobody wants them, and nobody wants to bail out at low prices either that owns them. And so these big banks are seeing their business models be threatened by low and negative interest rates. So at both ends of the financial spectrum, the really conservative insurance companies and the really aggressive big bank hedge funds, they're all suffering, and there's no real end in sight because it looks like interest rates are going to get more negative than they are today. That Japanese chart that has been viral on the internet lately, showing the yield on 30-year Japanese bonds just plunging, going, I think 10 years went sharply negative just lately, and 30 years are getting there, and that's a big bond market, the Japanese bond market. So if that spreads to the rest of the world, it's already true in Germany, but if U.S. rates fall commensurately, start trying to become equivalent with these other major bond markets, then insurance companies, money market funds, and big banks are threatened existentially. A lot of them just won't survive. And so we're seeing the market mechanism that self-corrects. When things get way out of balance, you see the market react to it by punishing and extinguishing a lot of players who don't belong there anymore in this new environment. and maybe rewarding some others. But right now, the punishment is the big story. So we're going to see a lot of major write-downs, multi-billion-dollar write-downs across the board among the big financial companies, and a lot of bankruptcies among the smaller, weaker players. So a really, really brutal couple of years is ahead of us unless something changes radically in the structure of the financial system going forward.
Negative interest rates have never existed before in history. Did the central bankers in favor of these negative rates think this thing out, how it could affect the banking and insurance industries?
Well, these guys don't actually have a coherent theory anymore because they've used up the tools that were part of the previous model, which was basically cut interest rates in the face of a slowdown and you generate more borrowing and that pulls you out of the slowdown. Well, they've cut interest rates over and over and over again to the point where they're in uncharted territory where they're cutting rates into negative territory. And there was a theory within their model that said you can't do that beyond a certain point. The zero bound was the term for it. You go beyond that and you start distorting the markets because people will just pull their money out of a bank if the bank is charging you instead of paying you for a deposit, right? You just take your money out, you put it under the mattress or buy a safe, and that's starting to happen around the world. Demand for high denomination paper notes is through the roof in Europe and Japan, and in Japan, home safes are selling out because people are cashing out of their bank accounts, getting big, bundles of yen, and they're putting that in safes at home. So you're seeing the market participants react to this distortion in the traditional relationships between cash and interest rates in ways that are really dangerous for the big players out there. And you're also seeing, as I said, a lot of business models no longer work in this kind of an interest rate environment. So right now we're just seeing inklings of it, where, there's big demand for $100 bills and 500 euro notes, okay, and safes are selling in Japan, and insurance companies are reporting lower earnings or having to take write-offs, and pension funds are reporting even bigger underfunding. Stuff like that is all happening, but it's not really hitting home yet. But when somebody big blows up, when a big finance company that people have heard of just crashes and burns, then everything changes, because then we start looking around for, well, who's next? If this could happen to, AIG, for instance, which is what happened back in 2008, 2009, if a AIG caliber company crashes and burns, or Lehman Brothers or Merrill Lynch or somebody like that, somebody we know about, then all bets are off, because it's not that big of a conceptual leap to say, well, God, if they're going bankrupt, how safe is J.P. Morgan Chase or Goldman Sachs, and then, or an Italian bank, Would we want to have our money in any Italian bank? And the answer is, of course, no. So you get the financial system just freezing up. And we're walking that path. We're heading that way now. When you see somebody like Lloyd's of London having to take multi-billion-dollar loss, or Credit Suisse having to lay off big chunks of its investment banking and trading operations, and we're not that far from it. By the end of this year or early in 2017, there will be a real chance of some kind of a black swan type event, somebody just blowing up on us and scaring everybody in the financial markets happening.
Is it time that central bankers had their salaries connected to the financial performance of their countries?
It's time that central bankers were all fired and replaced by clerks who exchange currency for gold and do nothing else, But, in the meantime, it would be a better world if all major public figures had their pay attached to some important metric. For instance, if the government, if legislators were only paid if the budget was balanced, we'd have a better world. And if central banks, if they had completely stable currency values, in other words, zero inflation, not this 2% or 3% or 4%, that they now think of as normal and desirable. If money was stable year after year after year, only then should central bankers be paid. In that kind of an environment, you'd have basically, in effect, the classical gold standard being reimposed. And yes, the world would be a better place. But see, that won't happen voluntarily, because that means you got to give up a ton of power if you're the head of a central bank or a congressman. If you're head of the Congressional Appropriations Committee in the U.S., you want to be able to deficit spend, because that's how you buy votes. That's how you satisfy your constituents. And take that away, and what's your job except to say no to people who get mad at you when you say no? Life gets hard again because you're making real choices. So we won't see that happen until the market imposes it. And which brings us back to the possibility of some big finance companies just blowing up. See, that's the market imposing discipline on an out-of-control financial sector. It's, if it just evaporates some big names, then all of a sudden discipline is no longer optional. It's what you do if you want to survive. You got to go back to being conservative and only lending money for productive uses, and only borrowing money if you're 100% sure you can pay it back, because otherwise the risk is unacceptable. That kind of a world is slower growing, much, much more boring from the point of view of a financial reporter or a financial bureaucrat or legislator, but way more sustainable. It's the kind of thing that lasts for decades and centuries rather than for a few years until something blows up.
Well, in Canada, the federal government has just released its new budget, and they're going to run $30 billion deficits for, it seems, the next 5 years. So 5 times 30, $150 billion in the hole by the time they're finished.
Pretty soon you're talking real money. And see, that's a normal response to a downturn for an economy that has seen losses in its main sectors. Canada's a resource-based economy, so that its budget just got a big hole blown into it by what happened in the oil and overall commodities complex. You can respond to that in one of two ways. You deficit spend, that's the Keynesian response, and take on a lot of borrowed money now in the expectation that that'll smooth out the cycle and keep you from having hard times in the moment, and then you'll pay off the debt later. Well, we never pay off our debt. So every time there's a crisis, we borrow very heavily to deal with the crisis, and then we just pile that debt onto the obligations of our grandkids. And so Canada, I guess, is doing that now. And see, that idea is spreading around the world, where a consensus is forming at the top of the global financial system that monetary policy, that is, manipulating interest rates, has kind of run its course. We can't go much below zero, or we get all these crazy distortions that we're seeing today. So now it's time for governments to go back to fiscal policy, to run big deficits again, and to try to generate growth with borrowed money. Well, that's getting perilously close to the whole debt jubilee idea, and to helicopter money. These terms that were kind of thrown around as worst case scenarios, things that'll never happen, but that could happen, if the central banks decide they really want to go for it. Well, it looks like it might happen. If the government borrows a huge amount of money and then gives it to people in some way, either by ramping up infrastructure spending and hiring a whole bunch of people who are now unemployed, or cutting taxes really dramatically and putting money directly back in people's pockets, or instituting a guaranteed minimum income, which is something that's being tossed around a lot now. That's basically borrowing money, giving it to people, and then having the central bank create new currency to pay off the debts that are incurred by the government. So in effect, we're just monetizing the operation of the government now. And that's kind of the last gasp before Weimar Germany-style hyperinflation, historically. So we're headed that way fast, too, and toss in a big financial company blowing up. And you've got the kind of situation where governments are just desperate enough to do something like this. So again, from an economic theory standpoint, we've got a really fascinating few years ahead of us, because we're going to do things that used to be kind of fairy tale, financial urban myth kinds of things, and we're actually going to do them now. So who knows how it works out? I suspect it's going to work out very badly, but exactly the details of the crisis that's going to flow from something like what we're talking about is really anybody's guess.
We'll have more with John Rubino right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with John Rubino. John, do negative interest rates increase the chances we'll see banks in serious trouble, which means that increases the chances they're going to have bail-ins, in other words, dip into your bank account to save their butts?
Yeah, that's what they'll do. And, that's just one part of the process, but they will do stuff like that because the plans are already in place in Europe and in the U.S. And Canada just passed something like that too, right? You guys have a bank bail-in plan in place waiting to be used. And I don't know in Japan, but I suspect, based on their history, that they would, in a heartbeat, go to bank bail-ins. Or they'll do old-style bank bailouts. Either one is a mess at this point. But yeah, when banks start failing, we will go after deposits in order to keep the banks from failing. Or we'll just print the money. There are lots of different ways to do this, and it all amounts to the same thing. If the government borrows a bunch of money and bails out banks, or if the government takes money from its citizens or bank depositors and bails out banks, either way, it's kind of a tax on citizens, because if you borrow a whole bunch of money and then create a lot of new currency to cover your debts, you're inflating away the value of your currency, and that's a hidden tax on people. If you take money directly out of bank accounts, that's a more overt tax. But either way, it's a tax, and so are negative interest rates. A negative interest rate is just a tax on savers, where the government takes money from people who are trying to put a little bit away for retirement or trying to live on a fixed income, and then moves that money to favored constituents like the big banks or the regulators or the people on K Street, the lobbyists, and in that way shifts income even further away from the 99% towards the 1%. So it all works out to the same thing. All these things have different names, but they all amount to an income and wealth transfer from people who don't deserve to be hit to people who, really do deserve whatever bad thing is coming their way, because they're the ones who benefited from the asset price inflation of the last 30 years. The reason that we have such huge disparities in incomes and wealth are because government policy has been directly aimed at that. We've created a huge amount of new currency. We've pumped it into the banking system. That new currency has found its way into stock and bond and real estate prices, which are primarily owned by people who already have a lot of money. If you're just making ends meet, you don't really have a chance to build up a big stock and bond portfolio or buy a London penthouse or anything like that, or a Van Gogh. But if you've got $10 million of extra income coming in each year beyond your savings, then you buy these assets. And so you're the one who benefits when governments push up the prices of these assets. So anyhow, that's the process that's been in place for the last 30 years. And under most probable policy scenarios, that process is going to be kicked into high gear in the next few years.
The International Energy Agency says a historic cut in investment in energy is perhaps going to cause a huge oil supply crisis, maybe not immediately, but in the near future.
Yeah. That's how really volatile markets tend to work. You get oversupply, which drives prices down, and then the people who are marginal producers get run out of business by the low prices. Then there's a shortage and it spikes, and I think oil might have one more of those in it before it's basically pushed off the playing field by solar power and wind power and new generation batteries and rising energy efficiency. The clean technology complex is growing at an exponential rate. And coal is already dying. The coal industry is basically just shriveling up right now and ceasing to exist. And oil is next in line. But because oil is primarily used in cars, and electric cars are not going to be as dominant in their market as solar power will soon be in electricity generation, it's going to take longer for oil to feel the same effects that coal is now feeling from a rise in new competing technologies. But that'll come. Let batteries get a little bit more efficient. Let solar power get cheaper at the same rate that it's getting cheaper right now for another decade, and it's game over. So we'll have one more pop in oil prices maybe if supply really shrivels because of the most recent price crash. And then at that point, oil will enter a downturn that will never end. It'll just be inexorable. Every year, more electric cars will be sold, more solar panels will be put on rooftops and in deserts, and the terms of that market, the relative competitiveness of these different technologies will shift in solar and wind's favor to the point that oil will not be seen as a viable fuel source 50 years from now. So
won't
here and there.
Won't oil still be needed though for aircraft, for ships, things like that,
No.
and also for petrochemicals and plastics?
There will be some petrochemicals that aren't replaced by clean tech, but a lot of biofuel technologies are progressing nicely. Where lubricants, for instance, can be made from plants. And as they get cheaper, they also compete with oil. But the petrochemical complex will be the last to go, or probably the last to go. But that's not going to soak up all the oil that we're producing at today's rates. So we'll need less and less oil in the future. But as I said, that's maybe a decade out when we start to see the effects of this really kick in, because we might have one more spike in oil. And a Middle East war or something like that could really accelerate the process. Where Saudi Arabia has a revolution, forget it. Oil goes back up to $150 a barrel. But that would be the death knell for the oil market, because at that price, anybody in their right mind who can will buy a mid-priced electric car and then just pay, local electric rates for their power. And so we'll see a massive shift towards alternative energy. And that's coming. But in the meantime, I think there's one more investment play in oil where the really beaten down stocks, although this might not be the bottom for oil, who knows? We just saw a huge build in oil storage just lately, and a shrinkage in available capacity. And so we're still overproducing, even at today's rates, which are lower than they were lately because a lot of U.S. shale production and Canadian shale production has ceased. But we're still overproducing. And if we continue to overproduce, we might push prices down for one more scary drop into the 20s. And at that point, though, zero is perilously close, and so we won't see much of a drop from there. And over the next decade, it'll probably go up again.
Even if the demand for crude oil goes down, will there still be a large demand for natural gas?
Well, natural gas is a power source for utilities primarily, because we don't yet use it in cars. We could. We could adapt cars to use natural gas, and they would be competitive at today's prices. So that's a possibility. And that natural gas is kind of extra capacity for a lot of utilities. They use it when they need it, and then they can just turn off the natural gas plant and stop producing until they need it again. Well, batteries are a direct threat to natural gas's viability in the utility market, because if batteries get cheap enough, then you just run your wind farm at excess capacity while the wind is blowing, and you charge up these batteries, and then you discharge those batteries when the wind isn't blowing, or you overproduce with your solar panels during the daytime when it's sunny, charge up batteries, and then run those batteries at night. And so it's completely possible that solar and wind and a few other alternative energy sources, if they keep getting cheaper and cheaper, also push natural gas out of the utility market. And again, see, Jim, I don't want anybody to invest based on this happening right away. This is a multi-decade process because the incumbent capacity is so huge. I mean, we have thousands and thousands of coal-fired plants around the world and millions and millions of cars out there with internal combustion engines, and they're not going to go away. They basically will run until they're scrapped and then possibly be replaced with electric cars or with solar-powered power plants, stuff like that. The transition will be great for clean tech investors because it's a long bull market. It's something with legs where it's like with with microprocessors, where every year demand goes up and has gone up for the past 30 years, right? Well, it'll be the same thing for solar and wind as long as no new technology comes along to replace them. So you can buy a really high-quality solar power company or one of the big-time wind companies and expect them to see rising demand for a really long time. And so assuming that their cost structure stays in reasonable shape and they don't make any big management mistakes, then their share price ought to rise along with their sales.
Well, I hear that the new technology for storing solar energy is as cheap as dirt. They heat sand using solar power, and so that sand is superheated. Then at night you run water through it. It turns to steam that turns your turbines, which makes electricity when normally solar power wouldn't be making electricity. And, of course, the world has pretty well an endless supply of sand. Yeah,
and that's one of many possible technologies for energy storage that are being tried out there now. There's another one where you pump water up a hill, store it in a big water tower, and then the water can run down when you need it and drive a turbine which generates electricity. And then there are lithium-ion batteries on a utility scale. There's lots of stuff that you can do. And all of them work. It's just, do they work at a cost that makes them competitive? And with the kind of research that's being done right now, huge amounts of capital are flowing into battery research, which is something that we really didn't spend much time or effort or energy on, or money, in the past, because we had pretty good batteries, We had batteries that worked for what we needed. And now we need bigger and better. And a lot of brain power is being directed at coming up with bigger and better, and I think they'll succeed. They seem to be succeeding. They're making progress year after year.
Kind of ironic. The original car was electrically powered.
Yes.
And because of its short range, gasoline took over.
Gas is a phenomenal energy storage technology. And, it's really dense. On one tank of gas, you can move 3,000 or 4,000 pounds of metal several hundred miles. Think about how much energy it would take for you to push a car that far. And then that energy is right there in a gas tank that's about the size of a couple of suitcases, And so that was a really tough thing to compete against for batteries from the 1920s or 30s, right? There's no way that those old batteries were going to compete against the energy density of gasoline. So what has happened in the past few decades is that modern batteries have actually begun to be competitive. They've gotten energy dense enough and cheap enough to maybe kind of compete with gasoline. And on top of that, they're subsidized right now by governments who want to make that transition. And so the combination of improving technology and really generous government subsidies is making these things competitive, and their cost curves are plunging. And so in the coming decade, if we extrapolate today's trends out, we get a 2017 or 2027 electric car market that is just phenomenal. It's completely different from what we have today. Much more efficient, much cheaper, and competitive straight up with internal combustion engines.
And if people are worried about power, one of our regular guests, Hilliard Macbeth, has just purchased a Tesla, and he runs it in ludicrous mode. It actually has that. and you go to 60 miles an hour, 100 clicks in just over 2 seconds.
Well, anybody who has driven an electric car knows that they're way more fun than most internal combustion engines. They're just smoother and quieter, and faster than most regular cars that are on the road right now. So if the average person can afford a Tesla or a Tesla equivalent, they'll seriously consider it. Right now, and as those things get cheaper, it'll be a no-brainer at some point.
John, thanks a lot for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.